Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Not going anywhere. Fed Chair Jerome Powell says he won't resign if asked to do so by President-elect Trump. This after the Fed unanimously reduced rates by 25 basis points, the second straight cut by the central bank. Plus, Asia stocks fluctuate as investors wait for the outcome of the week-long National People's Congress meeting in China.
In the meantime, a quick check on these markets. You are seeing green on the screen when it comes to European futures, higher by about 0.2%. Marginal moves to the upside. The currency picture is interesting because the dollar is doing two very, very different things. Strength against the euro, but weakness against the Chinese yuan. We're going to dive into the details. The countdown to the opening trade starts right now.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Powell steering clear of politics but firmly defending the Fed. No is a powerful word. Ding, ding, round one. Let's see what Trump does.
Yes, absolutely. This is fascinating, isn't it? I thought that in the context of a press conference where we saw Powell go out of his way to not talk about things that the president-elect might do, such as impose tariffs. What would that do to inflation? What would tax cuts do to inflation? Went out of his way to avoid all of that.
Yep. And
yet when asked a hypothetical question still about what would you do if you were asked to step down, he said no. And it's interesting that there must have been so much thought went into that. The parts of the Trump agenda and the Trump universe he would go near and the parts that he would not. It was all about Fed independence, wasn't it, essentially?
I just love the fact that the question was longer than the answer.
Yes, they don't have the TV skills, I suppose. But I think this is crucial in terms of context is everything here, because, of course, we do know there has been this tension. But in the last week or so, you've had reports come out of the Trump campaign that he's not actually looking to even push Powell out of his current at the moment. Exactly. And on the other hand, you also have this idea of what is the roadmap here? Is a traditional 2019 era Powell insurance cut via Trump tariffs exactly what Trump wants? That actually might work in his favor. So I thought that was interesting that he's not even talking about getting rid of Powell at the moment.
I think the interesting thing was, though, that the sense seemed to be that Powell saying not just me,
yes, everybody,
but all of us.
Yes.
So that takes in Barr, which sets up the fight, because Barr is definitely a target.
Yes, so
this is the head of supervision.
Yes, and yes, exactly, around the banking sector, a lot of focus there. I mean, this though really dominated other things that were talked about. I mean, you might even have to remind me what those were, because that was really the big story coming out.
The takeaway from it was, if you read between the lines, that inflation is back on the table.
Yes.
As a risk. That seems to be what the Fed is signalling. Therefore, the market has priced out some of the rate cuts that could have been put in for next year. It seems we're not going to get as far down as we originally thought that we would.
I'm wondering how much of this is so dependent on that House makeup, though, because if we do get that red sweep that we are likely awaiting or likely going to get, does that change some of the calculus there? So that, of course, is the monetary policy and the read-through there. We got some news on geopolitics as well. Just in the last 24 hours, comments coming from the likes of Vladimir Putin and Vladimir Zelenskiy on what a Trump 2.0 might actually look like. I thought this was interesting because the narrative around the read-through into Ukraine and the war in Ukraine has completely transformed this entire week. We started off the week, of course, ahead of the election, saying a Trump 2.0 would be a negative for Ukrainian assets, for Eastern European currencies, for some of the debt that's associated with it. A complete turnaround story that actually a Trump 2.0 may mean a peace in Ukraine, an end to the war. And that's something you're actually hearing from both sides, from both Vladimir Putin and from Vladimir Zelenskiy. I thought that was interesting.
Yes, but Zelensky using those words, saying a swift end would force the country into defeat. And so he's certainly not on that side, but also probably not holding many of the cards at this point.
We don't know. This is the problem. The sense was that once I win the election, I'll end this within a few hours. He hasn't spoken, in theory, to Putin yet. He's spoken to a whole range of other leaders
There are
as well.
70 leaders on his list. He's phoning them all, and we've got an interview with one of them, the Danish leader, later on in the programme. He's spoken to 70, and Putin is not on there. He has spoken to Zelenskiy. So, you know, that shouldn't need saying, I suppose. An American ally, and America is supplying a lot of weapons, but it does need saying when you're about to embark on a Trump presidency.
I mean, I just thought the idea of some of the proposals being considered a possibility, in Vladimir Putin's words, it's that they could be something that should be considered. Yep. And Vladimir Zelenskiy saying the commitment to strength that is the way that should be applied on the Ukrainian side. Fascinating comments from both leaders. We're
waiting to find out how Europe is going to be responding to Trump. We're going to find out as well how China is going to be responding to Trump as well. We're going to get the outcome of the NPC. It's been a week-long event. The market's kind of looking at the $2 trillion line in terms of the stimulus that could come through. Does China keep more dry powder on the sidelines, waiting to see exactly whether or not this Trump tariff policy is going to come into force? I have to say, you read the notes over the last 24 hours, the skepticism is already starting to creep in as to whether or not Trump will deliver on that tariff policy and will be as aggressive as he first indicated that he would be.
Yeah, like everything going into the first Trump presidency, the questions are all about, is he going to do all of the things he said he was going to do? How much of this is going to be transactional? Are there things that others can offer that stop tariffs being imposed or remove tariffs? But we did see quite a lot of tariff activity the first time around. I mean, just in terms of what we might get out of this NPC, it's been going on all week. There's a big focus on local government borrowing limits. That's going to be what we'll be watching for if we get any news out of this and what that does for infrastructure spend. But expectation management around this has been quite complicated. You talked about reading the notes. The views seem to be quite all over the place as to what we expect from this event.
It's also, I think, crucial here is that we should talk about the development of the Chinese consumer in the meantime, since the last Trump administration has been far more consequential to the global economy than it was the last time around. So the stimulative policy, I'm curious how much it shows up in the economic picture from a consumer perspective as opposed to from an export-driven perspective.
Can the Chinese today, and we're expecting results of this at some point today, can the Chinese thread the needle at this point, not disappoint the markets too much, deliver enough stimulus to keep everybody on board, but keep some dry powder just in case it's required for further stimulus to deal with the tariff story, which could theoretically slow down the economy? We have much to discuss. It's been quite the week, and we're not done yet. Coming up a little bit later on the show, very shortly, Yari Stein, Chief European economist at Goldman Sachs. We're going to pair him up with Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. We need to talk about Europe as well. The trade seems to be parity at the moment, euro-dollar. Is that what we're going to see? Yari thinks that actually we're going to get extra rate cuts coming through from the ECB. Chris Brightman, CEO and CIO of Research Affiliates, is going to be joining us. How do you push this Trump trade? Where do you push the Trump trade? And Bernie Arkong is going to be joining us, Global Multi-Strategy Alpha CIO at UBS. O'Connor will be looking for him to get his market take. Maybe also where to go to lunch this Friday afternoon.
That is his expertise, among many, many other things. Plenty of other data ahead of us in the next 24 hours as well. Now that the BOE and the Federal Reserve are in the rearview mirror, we are still getting some central bank commentary. 12:15 p.m. UK time, BOE's Hugh Hill will be speaking as well. Then some data over in the States. U.S. sentiment, of course, hitting at about 3 p.m. UK time. Interesting to see what that kind of consumer figure, that consumer feeling actually looks like over there. 4 p.m. UK time, the Fed's Bowman, the hawk on the Federal Reserve Committee. Interesting to see what she has to say on the heels of Chair Powell saying, well, actually, that CPI risk is still very relevant. Does she harp on to that narrative? And then today, of course, several sovereign ratings, Israel, Poland, and Spain. I wonder how much of the election commentary will show up in the Israel and the Poland piece as well.
It's going to be interesting to watch, the geopolitics being thrown in the air. How does it all land? I think we're waiting to find out. Market's very bad at pricing that kind of stuff in. This extra volatility makes it even more difficult. What else do you need to know this morning? Let's continue the conversation. The US President-elect Donald Trump has named Susie Wiles, one of the top architects, of course, of the 2024 presidential campaign, as his White House chief of staff. She will be the first ever woman to hold this role, which is amazing in itself, and, of course, will hold considerable power over West Wing operations. Soros Fund Management plans to shut its Hong Kong office as part of an administrative reorganization. The firm, founded, of course, by billionaire George Soros, will continue to invest in Asia with investments overseen from its New York and London offices. And the head of Germany's CDU is the clear front-runner to lead Europe's largest economy after Olaf Scholz pulled the plug on his three-way coalition. In an interview this morning on DLF Radio, Friedrich Merz said that Scholz's bid to delay the election until March was, quote, irresponsible, calling for an election as soon as possible. It seems that this story is accelerating. Merz is making it very clear we need to get on with this. And the market is signalling a backing for that as well. The market wants clarity here and, in fact, is welcoming what we're seeing coming out of Germany.
Yeah, it's quite interesting, isn't it, that stocks went higher on the back of an expectation that maybe we get some fiscal loosening, and that might be something that the market is looking for. You went through a number of charts yesterday, Kriti, talking about some of the fiscal space they have. They don't want to use all of that space they might have versus some in the Eurozone. But certainly there is this shifting expectation that perhaps this is a chance for Germany to do something different when it comes to the debt rate, when it comes to fiscal spending.
Yeah, I'm curious to see. We saw it in the equity market, to your point. We saw it in the bond market. We haven't seen it in the currency market yet. And I think Eurodollar that's been so sensitive to kind of the downside on Germany, when is it going to be perhaps kind of taking in some gains because the upside or potential upside that so many of our geopolitical strategists have said this is just confirmation of what we've known for months?
Or when is it not just a dollar story, I suppose, is the other thing this week.
So Beata Manthi over at Citi is putting out a note. She's talking about corporate tax cuts. You can see the corporate tax level being lowered from 30% down to 25%. That's more consistent with what we see in the UK, in countries like Spain as well. So that could have a read across back into the DAX as well, just from a corporate tax point of view. Similar story to what we're seeing over in the States in some ways. But it'll be interesting to see how this fiscal story is actually enacted precisely and how it impacts corporate Germany.
Yeah, absolutely. All over the detail. Plenty of corporate results still coming, or some at least, this morning. Coming up on the programme then, Richemont has reported a slump in profit in the first half of the year as the Swiss luxury group's watchmaking division suffered from cooling demand, there you go, in China once again. We'll discuss the headwinds facing the luxury sector. We'll watch for weakness in the luxury sector when those stocks open as well in around 50 minutes' time. Plus, British Airways owner IAG has announced a share buyback programme of €350 million. Numbers out from that business as well. More on that corporate story later in the show. Up next, we'll dive deeper into the fiscal challenges facing policymakers in the United States and in Europe as Donald Trump prepares to move into the White House come January. This, of course, for a second time. If you have any questions for our guests, please do send them to us. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Recent indicators suggest that economic activity has continued to expand at a solid pace. We got one inflation report, which it wasn't terrible, but it was a little higher than expected. We're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points, and we're asking ourselves, is that where we need to be? We're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves.
Fed Chair Jerome Powell there on the US Central Bank, its outlook and what it does next, I think is going to be an interesting question. Let's talk more about it. We've got a couple of panellists that are perfectly positioned to talk about all of this. Yari Stein, Chief European Economist at Goldman Sachs. Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Elsa, I'm going to start with you. It's been a fascinating week. The dollar's kind of round-tripped a little bit in so many ways. We went sharply higher as we got the Trump victory coming through. We faded that move a little bit. Yet what I'm hearing from Powell is that inflation is back on the table as a risk, and maybe actually we don't see so many rate cuts coming through from the Fed as a result of that. Walk me through, therefore, at the end of the week where you think the dollar should be and where it is, and is there a gap between the two?
I mean, at this stage, I think people are reluctant to get into very long dollar trades, particularly against the high-yielding currencies. You saw the round trip that dollar mex did earlier in the week. I do think, though, that euro-dollar at 108 doesn't seem to make a ton of sense.
No.
You know, it makes sense as a reaction to the repricing of US exceptionalism that we saw from early October through the month and into the election. But I'm not sure that we've priced in an awful lot more from Trump. And so you could say for a currency like that, that's not positive yielding against the US dollar, could take a chance on just sitting in that short euro-dollar position, as I think several people are.
Well, Yari, hop in on here from the economic perspective. If we're talking about this economic resilience, as Elsa talked about, how much of that is even relevant to Europe? Because at the end of that press conference, we talked about the risk of CPI inching right back up and inflation uptick, which, again, has been something that's been a bit of a warning in the last year or so. How much of this is relevant to Europe, or is Europe a completely different story?
Yeah, I think there's a lot of divergence now going on between the US, as you say. Resilient growth, rates are coming down relatively gradually, and then in Europe, where, of course, growth is a lot weaker. And on top of this, now we think there's a significant chance of renewed trade tensions, which we expect to drive quite a lot of divergence between the US and Europe. So we downgraded our forecast for growth across Europe earlier in the week. And we think the trade tensions that are likely are going to weigh on the cycle across Europe, particularly in Germany, particularly in countries that are open to trade, that are focused on manufacturing. And so we now only expect 0.8% growth for the euro area for next year, which is quite a bit below consensus and quite a bit below where the ECB has the forecast.
Yari, yes, it is below consensus. And I was in Germany earlier on this week, and some people saying to me, either it's too early to say because you don't know how much of this is transactional and they won't necessarily put all the tariffs on, and others saying that they don't think it'll have too much impact. I mean, how much do we take Trump 1.0 as a template for this? And when you're looking at tariffs, what's your assessment of how much damage Trump will do?
Yeah. So the interesting thing that comes out of our work is that it's actually much more about the uncertainty that trade policy creates and that feeds through into investment, into confidence, rather than the actual tariffs. So when you look back at the first Trump term, the US didn't actually enact many tariffs against Europe, and yet there was a lot of trade policy uncertainty that was created, and that really weighed on the European cycle. You had a huge slowdown in 2018 and 2019. And so we think that's probably the best template for the second Trump term as well, that he's obviously talked about broad, large tariffs on Europe. We might not get all of those, and in fact, we think that we'll probably only get a targeted subsection of that. But the point is that it will create a lot of uncertainty. We think that uncertainty will weigh on confidence, on investment, and that's an important reason for us to downgrade the forecast.
Yes, and so also thinking about Europe, I mean, 107, you're saying it doesn't make much sense. 108, it's about that level, isn't it, on euro-dollar? So just how much weaker should the euro be? What are you factoring in then, in the absence of any information about just what kind of tariff environment we get? How weak do you think the euro gets?
So I think what people are struggling with at the moment is exactly what Yari said. It's that uncertainty, that not knowing exactly what's going to come through. It is going to be a very difficult path lower for euro-dollar because we know that European growth is weak already. That was in the price. We know US growth was strong. That was also in the price. Markets are already short euro-dollar. But all of that said, we're not priced for material escalation in trade tensions. And I do think, if I look at the ECB's own forecast, a lot of what they were expecting was reliant on a recovery in consumption. They've been surprised by how consumers have not been willing to pick up spending and, and drive down their savings ratios. This kind of uncertainty is certainly not going to help that. So for me, it's more about that gradual decline low. I think people are unwilling to play it as an immediate trade. I do think it could take many, many months and quarters to fully play out, but the direction is lower. Parity is not out of question at all. It's just not going to be an instant, overnight, immediate move.
We're talking a lot about the effect from the United States, but what about the effect from the likes of Germany, for example? I mean, in the last 24 hours, we got a lot of political news, a shake-up for Scholz. In the next 6 months, really, we're going to get quite a bit of news out of there. But we're not seeing it reflected in the euro at all. Will it be in the next 6 months?
Well, I don't think the euro reacts to German politics as a kind of, you don't need to price in a negative risk premium. We're not worried about the stability of the country per se. It's more about whether the German leadership will be in a position to react to whatever comes out of the US. We've not talked about it much so far, but part of what Trump was saying on the campaign trail is, Europe has to pay its own dues. It has to, look at its own security. The US can't be the global policeman. That kind of longer-term geopolitical impact does have to get a strong European political reaction. And I do think that from a longer-term perspective, Germany is going to need that strong political leadership in order to get the response.
I'm really curious. So we're in a situation, I'm listening to you guys this morning, and I'm trying to figure out is this rock bottom for Europe? Could it get any worse? And you've got potentially a end of the crisis, political crisis in Germany. Let's not call it the beginning. This could be the end of the crisis. You could see the end of the war in Ukraine. You've got an ECB, according to Yari, that potentially could be cutting rates more aggressively than we originally thought. You've got a euro, according to Elsa, that could be going down towards parity. Maybe not in a straight line, but we could be getting down there. this sounds like the recipe for Europe to be in a good place going forward. Is this as bad as it gets? I think is the question that maybe a discounting market may be looking at.
Yes, if we're parking, and it's a big ask, if we're parking the geopolitical implications of allowing President Putin to get what he wants from some kind of win in Ukraine, if we're parking that, then, you know, do things look positive for Europe?
Or is this as bad as it gets?
Right. Well, maybe we go to Yari on that very concept. I mean, there are reasons that, as Guy outlined, that things could play out positively for Europe from here.
I think, you know...
Or are we clutching?
Well, I would be cautious. I think that, I mean, in a growth sense, I think, you know, I mean, we're saying that we're likely to move sideways at a sort of fairly subdued pace. So we don't have Europe sliding into recession. So I think, you know, in that sense, we don't think things will get a lot worse, but we also don't think things will get a lot better.
And does that assume no big change in Germany? Fiscally, debt break, all of that? No big rethink?
Yeah, I think you'll get some incremental changes. I certainly think it's an opportunity after the policy gridlock that we've seen. But I also think we need to be realistic. The Conservatives are fiscally conservative. The debt break is difficult to change. Even if you tweaked it, we think the room that would be created would be small. And then also the timeline. All of this is going to take time. So I think it's quite unlikely we'll get, you know, a lot of additional support in 2025.
Elsa, are we though at peak pessimism? This is the question. Are we at peak pessimism when it comes to Europe?
It's certainly part of the narrative, but it's hard to argue that it's in the price. And I think this is what people are struggling with. You know, a lot of people said kind of going into this election, OK, Trump's fully in the price. But what version of Trump was fully in the price? Because, again, for me, arguably at the kind of levels we're trading at the moment in currencies, it's hard to say we're priced for some real...
So 108 is not in the, 108 does not reflect peak pessimism in Europe. Does parity reflect peak pessimism?
Look, you know, when you start picking levels like parity from a long-term perspective, it's a very cheap level. And so if we get down there, you know, is it peak pessimism? I mean, Guy, you tell me what Trump's going to implement in his next 4 years of power, right? Nobody knows right now. I'm not even sure he himself knows. So I think, you know, to Yari's point, it's that uncertainty and that caution where you look for trades that don't have negative carry, where you can sit in the trade and you can wait to see what plays out.
But does that then kind of almost disconnect or disentangle what Eurodollar specifically does to the likes of spreads within Europe? Or is this really still a Trump story? Because if that's the case, does any of the geopolitical pieces or the data coming out of Germany even matter for the euro by that logic?
Look, it matters to the extent that there is still a group of people out there that, you know, are waiting for that European recovery. It's been a narrative for so long, the end of US exceptionalism, the bounce back in Europe. I mean, you know, to Guy's question, are we at peak pessimism? A lot of people still ask themselves that. And yet, you know, we're not yet at a point where we've seen the crisis that then generates the strong European response, but that leads to the recovery.
Does the debt break or the changes in the debt break, the changes in the issuance, the bond market plumbing, does that then not have an effect on the currency?
From the point of view of the euro, and more generally, I'd say, you know, all the work that we've done shows that the front end tends to be a lot more impactful than drive the currency than the back end. And to that extent, the fact that the ECB, yes, you know, they're cutting rates, but they're not in any rush to cut rates. We heard from Luis de Guindos earlier this week that, you know, December is too soon to start thinking about the impact of tariffs in terms of ECB monetary policy. It does feel like a story that's going to take longer to play out.
Fascinating conversation, one that I'm sure will continue over the next few months. Yari Sten, Chief European Economist at Goldman Sachs, and Elsa Lignos, Global Head of FX Strategy over at RBC Capital Markets, joining us around the table, I think answering the questions that a lot of folks in Europe have at the moment. Coming up on the program, we're going to continue that conversation with a little bit of a different lens. Where can investors find value under a second Trump term? We may have the perfect answer for you. Research affiliate CEO Chris Brightman will be joining us around the table next to discuss where those hotspots actually are. We covered the bond market, we covered the equity market, the currency market. Now we're going to cover the equity market and see if that U.S. exceptionalism story really extends. Stick with us for that conversation. This is Bloomberg.
Welcome back to the programme, everybody. 7:30 here in London, so half an hour until the European equity markets open up for Friday's trading session. The futures picture for Europe, then, let's pull that up and have a look how it appears this morning. It's pretty flat, not pricing in a great deal. We might see some movement in some luxury names. That could be an area of weakness. We had those numbers out of Richemont, so we'll keep an eye on that. IAG and the aviation space also in focus. Big picture, though, of course, we're coming off a week where we've been increasingly pricing in some Trump trades and then thinking about, well, just how far do they go? With that in mind, let's have a look at what's going on with bond markets. That Trump trade story has certainly been what's been driving treasuries. Over here in Europe, things have been a little bit different, and the market wrestling with what do tariffs mean for weakness in the European economy and therefore rate cuts from the ECB. We just talked about that with Yari Stern from Goldman Sachs. So one of the features of this week has, of course, been strength in small caps over in the United States. Let's pick up on that theme. Small caps have enjoyed a boost following Donald Trump's election win, with the Russell 2000 index hitting its highest level since 2021. Bloomberg's Valerie Teitel has more details. Val, good morning.
What it's been a week for the equity market. We have seen such a big outperformance in small caps, but also all-time highs for the S&P, for the NASDAQ, for the Mag 7, for the Dow. The only index to not hit all-time highs is the Russell 2000 index, but it's very close, just 2.5% away. A lot of this optimism in small caps driven by the regional banking sector. This domestically driven America First trade really gripped the regional banking stocks. They were up some 14% after Trump win. And the ETF, the KRE ETF, had the biggest inflow it's ever seen. So just, how quickly could we hit all-time highs on this small cap index? We are 2.5% away. I want to flip the board, though, and talk about some negativity. If you want to maybe think about the more pessimistic view on small caps, is that they're having an issue turning profit. If we look at the number of Russell 2000 companies posting losses, 44% of them are posting a loss in net income on a trailing 12-month basis. And if we do have higher growth, Guy, does that mean we still have higher rates? And does it make it more complicated for these small caps to turn a profit in the future?
That would be the theory, but the momentum's there. Val, thank you very much indeed. Let's talk more about this. Chris Brightman, CEO and CIO of Research Affiliates, joining us around the table. Good morning.
Good morning.
Time to fade the trade?
No. We published an article right before the election explaining how empirically the month following an election tends to be a pretty good month for the U.S. stock market because of the dissipation of uncertainty. And our thinking was that Kamala Harris conceding would be the one event that would be most likely to dissipate uncertainty. You know, if the AP had called it for Trump, he might not have called and congratulated Kamala on her win. And it might not have really been a dissipation of uncertainty.
But that's where we are now. So
that's where we are
now.
We found about the 20 trading days following the end of the election is the period of the exceptionally good performance. And we're weighted a little more heavily towards small caps than large caps, frankly, because they're so much cheaper.
But they're also less profitable, as we've just been hearing. Do higher rates pose a problem for small caps?
Higher rates, I don't know. It remains to be seen. I think the bond market is going to be the constraint on Trump policies, but the Fed cut.
The Fed did cut, but rates have gone higher. Over the last,
well, we had a 20 basis point pop in the 10-year yield when we woke up in the morning on Wednesday, but we've retraced at least half of that. Is what I saw this morning.
Over the last month, but yeah.
Yeah. I mean, good morning to you, Chris. I mean, over the last month or so, as the markets foresaw, to some degree at least, slightly uncertainly sometimes, but in the end were right to foresee a Trump victory. There have been some saying, we were pricing in a higher rates environment because the Fed is not going to be able to cut as much with Trump in the White House. That's not a view you subscribe to then? Is that you don't think he's going to be inflationary?
No, it's a good question. I think I am, like many, not fully confident of what Trump is going to do, but I think it's a good perspective that the bond market is going to be the arbiter of what policies are going to be acceptable. There's a famous political consultant in the U.S. Named James Carville, sometimes called the Raging Cajun. Many people might know him as the guy that said during the Clinton campaign, it's the economy, stupid. But I think he said something else that's more relevant to today's environment, and that is that if reincarnation is real, he wants to come back in his next life as the bond market, because the bond market can intimidate everybody.
We're familiar with this concept in the UK. But that hasn't always, I mean, you know, to what extent does that apply over in the United States?
Well, it applies
really
much
President
more.
Trump in check.
Yes, thank you. Much more so than I think the market and many people realize, because we have no fiscal space left in the U.S. We have debt to GDP at 100%, and a optimistic forecast from the Congressional Budget Office that we're going to be seeing 7% of GDP budget deficits and growing, and this from a starting point of above-trend economic growth. And so the bond market will be the constraint on economic policy coming out of the Trump administration. And I, for one, am optimistic. As I wrote in a recent piece, Churchill is reported to have said that Americans can be counted on to do the right thing, but only after they've exhausted all the alternatives. And I think we're reaching that point of having exhausted all of our alternatives to doing the right thing with respect to fiscal policy.
You bring it right back to the "It's the economy, stupid" quote from James Carville. When I spoke to some of the traders based in New York on the floor, investors at the major the banks 2-3 months ago, a lot of the consensus was that the market would rally regardless of who won, just given kind of the overhang. I'm looking at a chart here on my Bloomberg terminal that really looks at the correlation between the Mag 7, your NASDAQ heavyweights, and the small caps. And the correlation is 60 to 70%, depending on the 1 to 3 month time frame that you choose. And I'm curious how much of the momentum trade outside of Trump is now back and now baked into some of the small cap rally that we're seeing, that the smallest players and the biggest players are going to be trading the same way, maybe into the year and into a Trump administration. Well,
again, yes, your basic point is consistent with the empirical findings of our study, that the rally following the election is a dissipation of uncertainty, and it doesn't really have anything to do with the policies or the party that wins. Right. It is the knowing the result. With respect to our preference for small caps versus large caps, that's much more a valuation question and less about any kind of short-term momentum analysis or views on what sort of policy Trump will take. So in this environment, if we're talking about a general boost for the economy via tax cuts, via a deficit solution, even with a red sweep, for example, among many other kind of ideas, does breadth matter in this market, given that the lack thereof, or that valuation, that concentration risk, was one of the main reasons people didn't want to touch the United States? It was one of the bear cases for it? You know, the reason that large caps have been outperforming, I don't think is sentiment. I think it's the phenomenal history, which still is ongoing, in growth and earnings per share of those tech platform companies. So I think you should expect that they were going to continue to outperform so long as they have all of the earnings growth in the market. Is that going to change? History would say absolutely it is going to change. And I would say, well, you know, what is the catalyst? Oddly, it might be the CapEx competition in AI. There's an awful lot of spending on CapEx, and I'm not clear that they're getting any return on that. To that point, Guy, I'm tempted to say past performance is not a indicator of future results.
Well, you can see it in the multiples.
Yeah.
Are big cap stocks expensive right now? Are they too expensive right now? We are trading at what, 22 going forward? It's getting pretty punchy at these kinds of levels.
Yeah. The forward PE multiple is not nearly as good a guide to future performance as the Shiller PE multiple. That's why Shiller got a Nobel Prize.
So the capes look pretty high as well.
36. There are two periods in history when the U.S. equity market has exceeded the present cape. One was 1929 and the other was 1999. Not good company. Yeah.
Yeah.
Yeah, there's a nice reference point. You mentioned that about CapEx and maybe it not delivering, and we've heard from some of the big tech names, not all of them, crucially, this earnings season, some really key names still to come. Is that something we need to watch? Is this going to be a canary in the coal mine when CapEx starts to be pulled back by corporates because they're not necessarily seeing the benefits from their AI investment?
Well, looking at sort of fundamental factors that are drivers of equity market returns, we find that innovation is an important factor that predicts future outperformance. However, for quite some time, academics have published research on what's called the investment factor that basically says increasing CapEx produces poor equity performance. The reason that these tech companies have done so well is that they have had apparent monopoly positions that allowed them to extract rents and to produce terrific profits without much CapEx. Yes, lots of innovation spending, lots of R&D, but not a lot of CapEx. Now you're seeing them transition to being huge CapEx spenders, and there is a known published factor that investment, meaning CapEx, is associated with poor future equity market returns.
But is that just a function of the trillions on balance sheets that are still kind of sticking around post-COVID issuance, that easy monetary policy? Is that the incentive that's driving the willingness to invest?
I don't think so. I don't hold myself out as a particular expert in understanding what's going on with the hyperscalers, but my sense is that they are all feeling pressure that they need to come out of the other end as having owned AI, that they need to get in front of their competition.
At any cost?
At any amount of CapEx, whatever is required to win. I mean, Alphabet and Mette can't allow Amazon to win the race to AI.
I mean, you see that reflected in Apple stock, right? The minute that AI lag that they had or lack thereof. Chris Brightman will lead the conversation there, CEO and CIO of Research Affiliates. Joining us around the table to talk a little bit about the American equity market. We thank you so much. Coming up, we pivot to the European equity market. Stocks to watch, including Richemont, the Swiss luxury watchmaker's profit slumping on weak Chinese demand. We're going to dive into the details next. Stick with us. This is Bloomberg.
There are a lot of uncertainties out there, both in the world and there's domestic uncertainties as well. So we've emphasised the word gradual again because we're going to have to take account of how those uncertainties play through. I'm not really in a position, any of us are in a position to say, well, gradual means every so often. That is not a judgment that we make.
Bank of England Governor Andrew Bailey speaking to Bloomberg's Francine Lacroix just yesterday after that rate decision, that rate cut from the Bank of England. Let's move to other market matters. Rachel Evans joins us, Bloomberg's managing editor for FX and rates coverage for the US and EMEA. Let's move to the Fed story, shall we, and put Powell front and centre then, Rachel. When asked yesterday at the press conference, will you step down if asked by Trump, he says no. He said it twice. He then reiterated it's not allowed under the law, not just me, but other members of the Fed. I mean, he obviously feels, does he, that the Fed's independence needs defending at this point?
I think that was certainly the message that people took away from it. I mean, it's quite astonishing, really. We're very used to seeing central bankers giving us very academic, thoughtful answers. And he was so declarative and so blunt in his kind of assessment of what he would do in that circumstance. And I think that bears some kind of consideration, because I think that is exactly the question that markets have been asking about a kind of Trump presidency. What does this mean for kind of Fed independence? And I think Powell very much wanted to quash any concerns that people might have that could ultimately impact asset prices, that the Fed would be anything other than independent as it has been so far.
This is about the banking sector, though, isn't it? This is about Barr. It's not about Powell. Firing Powell's really hard. Firing Barr, there could be a legal route to that, but he's effectively putting Barr under the same umbrella as everybody else, and that sets the fight up. How far is he prepared to go, do you think? How big a conflict could we see? And that's got to be negative. If there is a conflict between the Fed and the presidency, that has to be a negative for the United States and the dollar.
Yeah, and I think also for kind of treasuries as well. I mean, like, people need to kind of see sort of, certainty in institutions to feel confident in the US as kind of like a home for capital. Obviously the dollar is the world's reserve currency. When things start to kind of sort of challenge whether the US is kind of, the city on the hill that people kind of see as being sort of the beacon for the kind of financial markets, then that does kind of have a ripple effect through to those asset prices. So I think it's going to be interesting to see how he kind of does it. This is definitely a first early shot across the bow, getting out in front of things. It remains to be seen whether we get any kind of fire back from the other side, as it were.
So politics aside, he also talked about the risk of inflation and uptick, and we've been talking about this for a year now. And in the last week, we've started to see the 10-year, for example, inch dangerously close to that 5% level again. Is 5% back in play?
Definitely, yes. People are very much talking about 5% as kind of one of those areas where we could see kind of the 10-year sort of trending back up towards. Obviously, there's a long way to go. We're not anywhere in that kind of ballpark yet, but that's the thing that's starting to come through in a lot of kind of the strategists that we talk to and investment managers, that 5% could very much be back in play.
But over what time frame?
That's a good question. I think we need to see some of these policies coming through from the new administration to see whether they are as inflationary as people see. We've already seen a large backup in yield, so it feels like any kind of extension in the near term might be a little bit premature. But once we start to see kind of those policies coming through, tax cuts and the like, that could be the thing that really sort of starts igniting the yields going higher.
All right, something we'll certainly have our eye on. Rachel Evans, Bloomberg's managing editor for FX and rates coverage for the U.S. and EMEA. She's a really fun job. Let's go from the macro to the micro and get our stocks to watch. Joe Easton standing by.
Morning, Kriti. So Richemont in the luxury space giving a bit of a weak update today, mainly due to the watch market, which they do say is softening. This is the key quote. The global watch market is experiencing a slowdown, particularly in China. However, they do say that the high-end segments are showing some resilience. And that final part of the quote actually plays into what we've seen in the big watch stocks this year. Richemont actually outperforming the other rivals, Watches of Switzerland, the retail group, which has a bit more of a mixed portfolio, and also Swatch as well. So potentially the more high-end watches is where Richemont might continue to outperform on sales. But for today, it could potentially be a weak stock this morning. Then over in airlines, we've also got IAG, the owner of British Airways, reporting some pretty strong numbers, and also a share buyback of around 350 million euros, which they announced last night. Now, some of their passenger numbers do look a little bit weak, but the main revenue actually holding up. We can see this stock rising almost 70% over the past couple of years, rebounding from that drop that we saw after the pandemic. Now, the interesting thing to note with this one is that it did decline yesterday. That was due to Air France's earnings. They were weak on a bit of a cost jump, and that did hit some rivals, including IAG. We can see that drop down there, down around 6% at the low yesterday, but actually recovered most of that, but potentially going to see more of a rebound today. Then in the auto space, we've got numbers from Pirelli reassuring the market, according to analysts over at Morgan Stanley. Now, the stock actually had a decent first half of the year, but then came off amid warnings from the sector. A number of parts makers and tyre companies have warned, so this is potentially reassuring. The street really likes this stock, though. 13 buys, not a single sell, so potentially expectations still high even after that recent decline. Then in terms of analyst ratings, got a few out today. Great Portland in UK real estate, that's a double upgrade over at Citi. Zealand Pharma in the obesity space got a new overweight rating, and Equinor over in oil is upgraded to buy over at ABG. All of those in focus as well today.
Thank you very much. Our equities reporter, of course, Joe Easton, with all of those individual names to watch. Something we're also going to watch. We're expecting a press briefing to take place in China coming up in around 10 minutes. So just time for the start of the European market open. And it's interesting because the finance minister is going to be speaking. We're also going to be hearing from the director of the budget committee of the NPC. So this is at the end of the National People's Congress, the standing committee that's been taking place over the past week. What conclusions have they come to, specifically around off-balance sheet debt for local governments? And that has been a headache for China for many years. It certainly accumulated a lot of that post the GFC, and now might we see some action being taken to remove some of the limits they have on that debt level, freeing up capital to be spent on investment, for example?
Tom McKenzie, who is my go-to, of course, on China. 2 trillion is the line that everybody wants to hear. If the stimulus package in totality kind of that we're going to get announced doesn't match up to that, then the market's going to be disappointed. If it goes more than that, that would signal that already we're starting to see some of the Trump trade effect being priced in to the China response. his expectation is that we actually see some of the dry powder being kept on the sidelines, though. So can they match expectations today? And then what's the ripple into the European equity space as well?
Well, I think the fact that the Chinese authorities are thinking about, they're almost putting their Powell circa 2019 hat on. It's like, what kind of insurance do we need for a very volatile 4 years that may be ahead of them?
Yeah.
To me, I think the breakdown is really interesting because it comes back to this idea of the Chinese consumer. How much of the stimulus, and that's where the debt program matters even more, is that how much of that is actually directed to the consumer. And my understanding is that not much at the moment. Most of it, to your point, Anna, is going towards local governments. And I wonder if that has an effect, not just in Europe, but in U.S.
Yeah, so if that is it, and we heard about a suite of policy measures, but this seems to be the one getting a lot of attention at the MPC, and if this is the one that the only one they're talking about today, is that going to underwhelm the markets? Is that going to underwhelm European stocks that are pegged to the consumer in China?
Chinese stocks fell after the announcement of this briefing and have faded into the close. So the expectation is already declining that we're going to see something more or over and above what was expected. Maybe there's an underwhelming briefing coming. Certainly that, if you look at the price action, that would you would see being signaled maybe.
Yeah, when we're talking about the market reaction as well, and I think this is so interesting. I'm going to bring it right back to the consumer because our editors and journalists on our top live blog, TLIV Go, they're live kind of previewing this for us. They're talking about Chinese liquor stocks actually surging on the expectation of that consumption boost as a function of the stimulus. And I think that's a fascinating spot to look at when it comes to just maybe one gauge of that potential strength.
OK, so that might be where we get some action at the start of trade. In terms of the other links between China and the European markets, we had seen a little bit of upside, I think, for copper earlier on. I noticed iron ore is now down by 2.3% in this morning's trading session. So we'll continue to watch what is happening with those commodities. Of course, they often have an impact when it comes to China. And, of course, the consumer read across from China into Europe. That could be evident as well. We'll keep an eye on Richemont, as we've been saying, because of the numbers that came out there and the China link with the consumer evident. This is the features picture then for European stocks. We are expecting, actually, these are improved a little bit, haven't they? Just over the last 50 minutes or so. So we expect a little bit of upside. US futures point slightly higher. This is Bloomberg.
Friday morning, good morning. I think everybody's looking forward to the weekend. It's been quite the week. Let's wrap up the Friday session, or at least get it going. Let's talk about kind of where the Thursday session influences the Friday session. White line, European equities, little fade into the close. The US picked up a little bit sort of subsequent to that, but later in the afternoon, that has still got to be priced in. We're keeping a firm eye post-Powell, obviously, on what is happening with the bond market. Kriti, what are you seeing in futures?
Green on the screen here, but is that an eerie calm? Is that what's happening when we look at what's happening underneath the hood? Outperformance in France seems to be the message this morning. How much of that might be a single stock story, higher by about 0.2%, but net, green on the screen across the continent, Anna.
OK, let's dive into some of those individual stock names. IAG, the owner of British Airways, of course, out with its third quarter earnings, beating estimates, high demand for transatlantic routes. Well, what does that say? That might say something good about the US economy, about the UK economy, maybe even about financial services. That often a fairly lucrative route for that business. Richemont certainly in focus as well. This on the luxury side of things, reporting sales for the first half that missed the average analyst estimate, but they were stable at constant FX rates. A lot of focus on the weakness of the Asia number. That's as close as we get to some disclosure around China and what kind of weakness we see there. Here's an interesting one. Pirelli, the tyre maker, delivering its numbers. The adjusted EBIT coming in above analyst expectations for the third quarter. Morgan Stanley describing the tyre maker's performance as reassuringly resilient, which for a tyre maker I think is probably a good thing, Guy.
Absolutely. Does that signal, though, that people are driving older cars because they therefore have to replace their tyres? I don't know. Maybe there's some sort of signal in there about the EV space there as well. Let's talk about how the European Open is looking as we head into this Friday session. A little higher, I think. Maybe on the back of the outperformance yesterday that we saw at the back end of the US session. But here we go. The Friday session is almost upon us. Let's take a look at the numbers we are getting. We're expecting 0.2, maybe 0.3 to the upside for most of these main markets. We'll be interested to see how the China story folds in over the next few minutes as well. Remember, we're expecting a briefing. So here we go. The FTSE 100 up by 0.1. Let's call it 0.2 as we begin to climb a little bit higher. No, let's call it 0.1% higher. The Stock 600 barely budging as well. Not much action here. Maybe there is a sense of exhaustion as we head into this Friday session after the tumultuous week that we have had. The IBEX, as expected, actually a little bit softer this morning. The DAX clearly has no news because it's opening early relative to where it normally opens, up by 0.2%, and the CAC is up by 0.2%. So 2 to, let's call it 0.3% of 1%. And maybe I'm stretching it a little bit. Kriti, what are you seeing below the hood?
Well, it looks like this is a Guy Johnson Core 6 kind of day because those are your big movers to the upside, at least when it comes to index contribution. Novo Nordisk, SAP, and ASML at the top of the pile when it comes to the gains that you're seeing on the screen. To the downside, though, and we are seeing a little bit of a mixture of some of the weights on this index. A lot of this seems to be a little bit in the banking sector. I'm seeing a little bit of Santander and a little bit of BBVA as well, which might explain that red on the screen that Guy was talking about when it came to the IBEX as well. So the bank stocks seem to be the underperformers, but even they are just flat right now. The rest, it seems to be tech, healthcare in the driver's seat, a defensive trade on the surface, Anna.
Yes, and looking at what we're seeing out of China, because we set this up at the before this break, didn't we? We talked about what that might lead to. We're seeing China's top lawmakers approving the local government debt swap plan. There doesn't seem to be any number attached to that just yet, but this press conference is just beginning. These are live pictures coming to us. And as I mentioned, China's top lawmakers approving that local government debt swap plan. So what does that do to the local government's ability to invest in local infrastructure? What does it mean for urbanization in China? That's been something that local governments has seen as quite big drivers of. So we'll certainly keep an eye on that and everything that leads into that trade. We'll be looking, of course, for how this affects the mining sector, for example, if it's all about infrastructure build.
As Kriti said, there's a fantastic T-Live, Top Live, TLIV Go is the function you need to use. A live blog as this event unfolds in China. People are taking pictures as everybody settles in, but I suspect we're going to see some policy announcements over the next few minutes. So TLIV Go, place to be.
Absolutely.
And you should maybe stay
I mean, maybe here first.
Yeah, here first.
We'll have them both, all right here. But look, not seeing major reaction in the currency as well. We'll see, of course, what those comments look like. In the meantime, I was all ready to talk U.S. election. I think the last 90 seconds has completely changed my roadmap. Let's bring in Bernie Akong, Global Multi-Strategy Alpha CIO at hedge fund manager UBS O'Connor. Pleasure to have you on the program. Maybe we marry the two key topics here. What is a bigger mover for markets right now? Commentary out of President-elect Trump, or what we're going to hear out of China?
Definitely China. I think the market is waiting to hear whether there's going to be something on the consumption side. As you said, the headlines right now look like it's just a debt swap, which is frankly not going to be that exciting for markets. But the big factor is really between now and the end of the year, are we going to get some incremental stimulus on the consumer side from China?
In terms of how we price this in, where we price this in, do I play this through China? Do I play this through Europe? Where's the underpriced trade around the China narrative?
I think you can play it through European cycles, which don't necessarily have to have that direct exposure. The problem with that direct exposure is not only just, are we going to get the stimulus, but obviously, what are we going to hear out of Trump now and from the tariff side? There are a number of European cycles which aren't in the direct line of fire, which will benefit from improved China stimulus, but also are going to be helped by the fact we're seeing right now orders to inventories improve. Like October, that's the story that's not getting talked about so much, actually. October, the data you saw coming out of Europe in terms of orders to inventories, as well as US and China, is dramatically improved. And if you look at the ECB lending survey for Q3, Germany is leading in terms of improvement across a lot of Europe. So that's going to help European cycles, and the China stimulus could be just a kicker on top.
In terms of the Germany trade, is this as bad as it gets? Are we at peak European pessimism? Does it get better from here? You just factored in the China trade. You got a German election coming up. You got euro-dollar potentially heading down to parity. ECB is going to be cutting rates a little bit more aggressively. Does Europe stick out as the kind of the underpriced asset right now, or is that still China?
From a cyclical perspective, to me, it does. I mean, I think it's something we've probably discussed before, where structurally I still think there's a lot of question marks in Europe. But from a cyclical perspective, it does stand out as the one where there's not a lot priced in. I think I saw one survey the other day where people had to vote on what their favorite equity index was going to be in terms of the next few months' performance. And I think out of survey maybe 150 voters, I think one voted for Europe. It's pretty depressing when you see that. But from a cyclical perspective, I mean, you touched on Germany. I think the other thing that's fresh and live is what we saw yesterday in terms of the government, starting to fall apart and really call for snap elections. I do see that as a positive. I think that is a signal that we're going to have a pivot from a fiscal perspective, which has to be more supportive. And frankly, the economy needs it. And that's going to be, bring, I think, a different, renewed confidence from a lot of the corporates and then, therefore, investors.
Let me just go to a few lines coming out of China. So we're seeing the Finance Ministry and the NPC giving this briefing. They're talking about the scale of this debt swap, local government debt swap. 6 trillion yuan in local government special bonds is being discussed today. All this 6 trillion yuan are local special government bonds. The debt proposed... Anyway, lots of lines coming through, and they all have 6 trillion yuan attached to them. I saw a range of 6 to 10 trillion, so we'll see how this goes down with the market. The IMF has said that there's 60 trillion in total in terms of this supposedly hidden debt in China. We'll let the market digest some of that and see how that goes down with investors. But what's at stake for Europe in this is interesting, Bernie, as you were just uniting these themes, talking about Germany a little bit there. You know, Germany has, according to some of our analysis I was reading this morning, not just a cyclical problem, but a structural problem, and an over-reliance on the Chinese demand might have been one of the things. I mean, that's a bit of structural and cyclical, perhaps. Maybe they need to take action on both. There's still quite a lot at stake for Germany in what's going on in China, I suppose, is where I'm getting to.
Yeah, no, absolutely. And just on those numbers, I would say 6 trillion local government debt swap, that's probably in line with, you know, expectations. I think to really have a positive for markets, you want to see something which is 2 trillion or above, specifically talking about consumption-related stimulus. So at the moment, what we're seeing, I would say that's going to be a slight disappointment in the margin. And specifically to your question around Germany, yes, they're still going to be reliant upon China in the near term, you know, for their growth. I do think with a new government, you're going to see them start to pivot and change some of the policy to focus more inwards and domestically. Things like, you know, obviously lowering the tax rate, like the CDU, CSU is talking about, is going to be important. They're going to probably give a number of incentives, I'm guessing, to smaller, domestic-focused companies and businesses. So I think they recognize that, and they're going to have to transition.
Speaking of that transition, I mean, off of these China headlines, we are getting, I should mention, a little bit of weakness, of course, in the Chinese yuan and a bit into U.S. Treasuries as well, which I thought was interesting coming off of these headlines. I want to pivot back to the U.S. story because we're talking about taxes, fiscal sustainability as well. Talk to us about the range on the 10-year now that we have a Trump administration. I think we'll have a Trump administration.
That is the key risk. So, like, when people ask me what could derail, you know, this optimism now post-elections, I think it is really the level of the 10-year. So, you're right to focus on that. And for me, I think it's going to be a level which is probably 460 and above. Why do I say that? I think 450, you know, is a threshold. Obviously, it's you know, which people talk about a lot. You have a lot of advisors recommending to their clients buy treasuries at 450. It's almost a no-brainer, I hear some people say. I think people are going to get concerned when 10 years move sustainably above that level. They're going to say, hey, you told me to come in and be buying treasuries for 430, 440 as we get closer to 450. Why is this not working? Why is it why treasuries continue to sell off? And then people are going to start to worry more about some of the negative effects we've talked about in terms of Trump coming to power and obviously having a Republican-led Congress. That is the key issue for equities. As long as we don't have that, I do believe we can continue to trade in a very favorable fashion in the near term. But that is the risk I'm watching out for.
So in theory, we are all in the volatility business, you included.
Right? Absolutely.
So that's what we do. How are you going to handle Trump tweeting? I'm not sure we tweet anymore, but how does the world change for you as we enter a new Trump administration, just in terms of the way you manage money and handle risk? Does the risk of a kind of off-the-wall Trump tweet change the way you think about how much risk you're prepared to put into any given position? Is the first Trump administration going to be different to the second Trump administration? How are you thinking about what the next 4 years look like, just in terms of risk management?
Great question. Lots of things I can say on that. The first thing would be that I do think the administration will look slightly different. I think he's learned a little bit from the first time. I think you can see some of the people he's going to appoint and put into power, I would argue, are going to be more business market friendly-minded people. So I do think that's going to make for less controversial headlines. But the second more structural thing I would say is post-COVID, we've really had to deal with headlines coming out all the time in an unexpected fashion. So I actually don't think it's going to be a dramatic change in that sense. You know, within what we do in our business, we're very liquid. We shift things around very quickly. And I think you have to be in that sort of mindset and that sort of structure to cope with the next 4 years of what's going to come.
Lunch today?
Smoking goat.
Smoking goats. There you go.
For those who feel that question is a little out of the blue, this is because Bernie is an expert on places to lunch.
Yes, and it's one of the great places to eat in the area in Shoreditch. So,
Shoreditch.
Yeah.
Excellent.
He's a fan of Shoreditch lunch eateries.
Absolutely.
Anyway, if you want to find him, that's where he's going to be. Bernie Okong, not that you should. Global Multi-Asset Strategy Alpha CIO at UBS O'Connor. Thank you very much indeed. Core 6 looks like this. Mixed this morning. Look, Ferrari's a little soft, LVMH is a little soft. LVMH is really quite soft, actually. That's interesting in the light of what Richemont said this morning. They're seeing weakness maybe in the watch side of the business. I wonder if that's reflected in the LVMH numbers this morning as well. Nestlé's a little soft as well. Tech looks broadly bid. Novo's been really bouncy this week, really choppy, that stock. It's been one of the big movers in terms of the volatility around Europe. Let's get some individual movers. Let's get some more individual movers. Here's Joe.
So one big mover today, Guy, is over in UK home building. Vistry down 13.5% at the moment. The company warning that it hasn't quite fully stated some of its costs, and they've had to re-add that to their latest earnings, according to a statement today. And also, they have actually downgraded their forecast for home building in the UK as well, alongside that cost issue at the company. So that one really hit hard, down almost 14% now for Vistry in UK home building. Then, in terms of Richemont, I think you are right in terms of Richemont numbers hitting the luxury space more broadly, but we can see weakness in watches specifically. So Richemont itself coming down 2.8%. Swatch Group over in Switzerland also down 3%. Watch of Switzerland here in London, the Rolex retailer dropping 1.6% as well. So clearly hitting the luxury and watch space specifically. Now IAG over in airlines, this one looking pretty strong. Now remember, there was a buyback last night as well, alongside pretty strong sales numbers for the company. Passenger numbers not great, but the stock heading higher as I speak, up around 7% at the moment for that one. Then over in the tyre space, Pirelli, we said reassuringly resilient was the phrase from Morgan Stanley this morning, and that is up 1.7%. Sales holding up, a number of profit warnings from that sector specifically. Over in gambling, Entain is weaker today. This coming from DraftKings in the US. Now, DraftKings actually saying that sports gamblers in America did really well in the last quarter, and that is not good for US bookmakers. They have been paying out more money, and that's reading through into Entain, which runs BetMGM over in the US as well. Now, a big decliner that wasn't on our radar is Serco. This stock absolutely slammed today. Now, believe me when I tell you, this is actually Serco falling as it loses a contract on the Australian immigration bid, according to a statement from the firm. They lost a contract on Australian immigration. Now, please ignore Southern Energy. I'll be having words with the producer later on that one, but it is Serco, believe me. That's the stock that is down this morning. Then, in terms of your ratings, we mentioned Great Portland. Now, this is a company that owns a lot of land all around London, a lot of portfolios. This one is gaining on a double upgrade over at City. There's notes of trough valuation on the stock on that one. And finally, Guy mentioned the Novo Nordisk move. It's been pretty crazy for that stock this week. But the other obesity stock, much smaller, is Zealand Pharma. This one, it's overweight, no pun intended. It is an obesity stock. But Zealand Pharma is up 8% today as JP Morgan upgrades that stock to overweight. They like that one as an alternative to Novo Nordisk, the best performer in Europe today.
Joe, thank you very much. Joe Easton from our equities team. We will come back with an update on what's going on in China. A lot to talk about there this morning and what's happening to markets in the wake of that. We'll also focus in on the aviation sector. As Joe mentioned, shares of IAG in the green after delivering a third quarter beat. More on the results next. This is Bloomberg.
Welcome back. We're getting lines out of China. We're 70 minutes into the European session. The China story is one you definitely want to pay attention to. The finance ministry is currently briefing. The finance minister is currently briefing. We'll show you the live pictures of that just in a second. Just to recap, the debt program is being pushed through. Looks a little bit cautious, maybe in terms of relative to expectations. He is, though, saying that it will cut local debt burden to 2.3 trillion yuan from 14.3. So that's quite a big reduction. As Anna's just pointed out to me, the swap will allow resources for investment and for consumption.
Yes, we'll see how that is expected to work through, because you can see the link to investment spending and to construction, perhaps. The consumption line, we'll have to see. This is having an impact on risk sort of risk-aware assets here in Europe. So we see the euro taking a leg down on this, down by 0.3% against the dollar. The Aussie dollar, obvious links to China from that economy, of course, that's down by 0.7% now. We're actually seeing German bonds gaining. There's a lot of other noise happening in the German bond story right now, so I'm not sure about that. But we are certainly seeing a reaction, and the Chinese currency, of course, is one of those that is weakening as a result of this.
It's going to be really fascinating, especially on that consumption line, because you're already seeing that in pieces of the European market. And that's where maybe we connect the macro with a little bit more of the micro here in Europe. Richemont shares, for example, are down this morning. And, of course, there's a lot to kind of connect the dots between luxury and China as well. The Swiss luxury group reporting a slump in profit in the first half, citing weakness in its watchmaking division caused by, again, falling Chinese demand. Those shares down just shy of about 3% this morning. Bloomberg opinion columnist Andrea Felsted joining us around the table for more. Andrea, connect the dots for us here. Talk to us about their performance.
Well, China is weighing on all the luxury groups, and we've seen that with Richemont. Jewellery is holding up, but watch demand has really come under pressure, and it's really that lack of demand for watches that is behind the weakness.
And China in particular then, Andrea?
Yes.
Or do we know? Because they talk about Asia, but we suspect that's China.
It's really China. It's China and it's watches. There is less demand for those, upmarket watches, IWC, A. Lange & Söhne, Panerai, all those types of models.
So what does this mean going forward for the group? This is a hard luxury group. How does it move forward from this? Are there other areas that we can see pick up in demand? What does this mean in pricing for everywhere else? They've been the watches have gone up a lot over the last few years.
They have.
Does that now taper off?
It probably does a bit. They were still quite upbeat on China for the long term. Don't want to pull back their visibility and presence there. They said they couldn't tell when it would turn, but they did expect things to improve in the mid-term. They didn't put any...
Because others are signalling that they think that China's bottom now and it's going to improve from here. Other luxury groups.
Yes, there's not a lot of visibility. I think, I don't think anyone's expecting it to rebound. We may be at the bottom, but there's not a lot of visibility on when it's going to come back.
Andrea, thank you very much indeed. Andrea Felsted of Bloomberg Opinion on what is happening at Richemont and, by extension, the luxury sector this morning. Let's turn to what is happening in the aviation space. British Airways owner, Iberia owner, Aer Lingus owner, IAG has posted third-quarter earnings, beating estimates on higher demand for transatlantic routes. Let's get the details now with Benedict Camel, Bloomberg's global aviation lead. Benny, let's start with the numbers. These numbers are really strong, and I can't help but compare and contrast what we've just heard from Ben Smith a couple of days ago at Air France and what we're hearing from Luis Gallego at IAG this morning. Why are they in such a different space? Why are the numbers so different at IAG versus Air France KLM?
Well, the short answer is transatlantic. That's really where the strength is for British Airways in particular. That's the market that keeps delivering for them. And that's where, as we heard from Luis Gallego this morning, the CEO of IAG, that's where they want to put more capacity. If you look at it regionally, he said, this is really where the growth is. Asia, by contrast, is where we're going to focus less. And it'll be interesting to see whether they might pull more capacity out of the Asian market and redeploy it into the transatlantic routes. We already heard from them a couple of weeks ago that British Airways is cutting its London-Beijing route. So we'll see if more will fall victim to that kind of split screen, shall we say, between what's happening on the transatlantic market, very strong, and the Asian market that's sort of just ticking along but not really growing.
Well, how much of that is actually impacting the outlook here? I mean, look forward to us. Look forward for us if you can.
So the outlook is fairly strong. They said they expect the rest of the year to remain strong. They expect costs to remain low. That, again, is a contrast to what we heard from Air France yesterday. Those shares yesterday really took a clobbering, falling quite dramatically. And you can see the contrast also in the stock today. IAG up significantly, the most in more than 2 years. And one thing they did say was that they are taking their capacity expansion, so sort of the number of seats, simply put, down ever so slightly. They now see capacity expansion at 6%. They previously saw 7%. A little bit of that has to do with Asia. Some of it has to do with issues they've had with Rolls-Royce engines. And that's a space that we'll have to keep watching. If there's one fly in the ointment for IAG in a very strong set of results, it is that they can't fly their Dreamliner planes, the 787s, in the way that they wanted to because they have issues with those engines. And that's going to be something that might actually damp their growth a little bit going forward.
OK, Benny, take us through a bit more on the transatlantic story, because this was always an area that they generated a lot of profit from, and specifically the front of the plane generated a lot of profit. Now, the front of the plane has been challenged since COVID, and I wonder if they're saying anything about that pickup in business travel. Do we get any clues around the business traveller from these numbers or from anything else we've heard from other airlines?
That seems to remain fairly strong. The business travel market, you're right, has been challenging. And what we've seen since COVID, really, is sort of a migration from the back of the plane to the front. So more people who would normally fly economy or premium economy had sort of pampered themselves, had moved up and gone into business and maybe even first. That is starting to slow down a little bit. And we're seeing some return of corporate travel, certainly not to the degree that previously existed pre-COVID, but it's coming back a bit. But if there's one thing about the transatlantic market, that remains a really strong corporate market. And because British Airways in particular, and also Aer Lingus, have a really strong hold on that market, that's helping them quite a bit, and you're seeing it in the numbers.
Benny, I hear what you're saying about the North Atlantic. To what extent, though, also is there a difference between some of the European carriers in terms of their fleet? We talked earlier on this week about the fact that Air France has a high maintenance cost problem at the moment. You've alluded to what is happening with some of the wide bodies and the problems they're having with Rolls engines. But does Air France have a bigger maintenance parts cost issue than maybe IAG does? Are there other ways of looking at this other than simply what the top-line revenue number looks like?
That seems to be the case. I mean, IAG, as I said, or British Airways in particular, has the issue of the 787. Those are flown with the Rolls-Royce engines, and that's something that might really cause some problems for them going forward. If you compare it to Lufthansa, if you look at the three big companies, IAG, Air France and Lufthansa, Lufthansa is probably the one that has the biggest sort of maintenance and old aircraft issues, just because they haven't upgraded their fleet to the degree that the others have. British Airways and IAG more broadly have been fairly good at upgrading their fleets. Iberia is now getting the first 321 XLR, so that gives you a sense of just how modern their fleet is. Aer Lingus has also done it. British Airways has a lot of new aircraft in there. So of the three, they're probably in the best position in terms of the relatively low maintenance costs, a relatively new fleet, and they expect quite a few aircraft to come into the market next year. So that'll continue to help them.
Thanks very much, Benny. Good to speak to you. Benedict Camel, Bloomberg's global aviation lead, with us here to talk about what's going on in the aviation sector. He was talking there about weakness in Asia and the weakness in the Chinese economy, certainly a feature of programming today. We've got assets on the move as a result of an underwhelming briefing coming through from the officials at the National People's Congress. It's ongoing, though. Iron ore prices down by 3%, just one example.
It's the currency's definitely taking it a little on the chin this morning, isn't it? We're certainly seeing some examples of that. We're going to leave you with live pictures of the briefing that is following the NPC. The NPC is now closed. It has been a tumultuous week on many fronts this week, and this is just the latest. But you can see the reaction in dollar offshore as you watch this unfold. We'll continue to monitor this story very, very carefully over the next half hour. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's session, seeing risk sentiment a little volatile this morning. It was 30 minutes ago. The markets were largely in the green. Now they're in the red. You are seeing them pair some of those early gains. We're going to keep you apprised. Marginal moves on both ends, but still a little bit of jitters pretty apparent in the equity market this morning. Let's go to a little bit of big picture. It's been a volatile week, of course, in geopolitics as well. The Danish Prime Minister has told Bloomberg she feels reassured that the U.S. will continue to work with Europe after speaking to President-elect Donald Trump. Bloomberg's Oliver Crook caught up with Mette Frederiksen not long after her phone call.
First of all, I had the opportunity to congratulate the new elected president. I know him already because we used to be colleagues back in time. We had a long discussion about some of the topics that are a big concern for US and for Europe. Of course, the war in Europe, Ukraine, the closer cooperation between Iran, North Korea, Russia, and unfortunately also China. We talked about defense and deterrence and the future of NATO. We had the opportunity to talk about Israel and the situation in the Middle East, and also our common concerns about Iran. So it was primarily a discussion about security, defense. I am really transatlantic. And I said, of course, to the president that I hope there will be no conflicts, no bad discussions between Europe and US, because I think, especially in this world of today, we really have to stick together.
And what parts of the conversation were you most encouraged by? On what topics do you think you see most closely eye to eye?
Well, I would say, first of all, what I see is a US president who is spending a lot of time these days in reaching out to partners globally, worldwide. That is, of course, important, but it's also something that we are thankful about from a European perspective. I heard the president being very direct in saying we have to solve these problems, and I did not see any signs of, US is here and Europe is there. I had the feeling that we are going to talk about these issues, we're going to try to solve them together.
And even on this subject of Ukraine, because of course this has been, I think, the largest concern for a number of your colleagues and yourself, I imagine, in the lead up to the election. Were you reassured about what he had to say about Ukraine? Do you know if he's, open to talking to Vladimir Putin? There had been this sort of 24-hour ultimatum you talked about.
I think it's better that you ask the incoming president about what will be the priorities seen from a U.S. perspective. But I had no bad feelings about a U.S. moving away from Europe or a U.S. moving away from taking up on responsibility for what's going on globally. And of course, from a European perspective, that is important.
The Danish Prime Minister speaking exclusively to our very own Oliver Crook. He joins us now from Budapest, where European leaders are meeting. Ollie, in your conversations, have you gotten the sense that other leaders are also reassured?
Yeah, Kriti, I think that is generally the sort of message that we're getting from European leaders here. I think that there's a real sort of reticence to be firing the first shot or saying anything negative about Donald Trump, though it is no secret that to many of these European leaders, this is not the desired outcome of the U.S. election. But now they're facing that sort of reality and basically trying to approach it with a cautious reality. But, the reality of the situation is, and Mette Frederiksen is a great example of Denmark, when Trump, for example, canceled his state visit to visit her after she refused to talk about selling the United States Greenland in his first administration. So there is sort of that other sort of side of this trade for many people. And I think that the other message has been on Ukraine that basically Europe can go it alone if indeed the United States decides to pull back. Whether or not that is reassuring to President Zelenskiy, who looked fairly downtrodden yesterday when he came in and didn't really stop for any questions from journalists, is a separate question, particularly now as we're starting to see the other side of this equation and whether Trump will speak to Vladimir Putin. And in fact, we heard from the Russian president yesterday. Have a listen.
I do not want to comment now on what was said consciously during the election campaign. I think it was said deliberately in the fight for votes. But it does not matter. What was said in the desire to restore relations with Russia to help end the Ukrainian crisis, in my opinion, seems to deserve at least attention. I would like to take this opportunity to congratulate him on his election as President of the United States of America.
And I could tell you that despite that is not the sort of overarching view that Donald Trump should be speaking and engaging with Vladimir Putin, it is the view of some of the people I've spoken to here, including Viktor Orban's top political aide, who's actually been the sort of liaison between Hungary and the Trump administration, saying that there should be open lines of communications. Trump has indicated that he's open to speaking to Vladimir Putin. But for the Hungarians, there's a much broader story at play here. It's not just about Ukraine. He's talking about this is really a moment for Hungary and for the values, the Hungarian values of this government right now, to basically be put on an elevated level right now, and saying pushing back against what he calls the sort of Western liberal and woke values of Europe.
Right, and we know that Mario Draghi is in attendance where you are, Ollie. He was there to talk about competitiveness, and I wonder if his presence and now what's going on in Germany adds a sense of urgency. Any signs that Europe is heeding some kind of wake-up call here?
Yeah, I think that when we speak to a lot of the leaders who have come in today, today and yesterday, is basically saying that this is a sort of moment of wake-up call for Europe, right? And this is sort of the Mario Draghi agenda. This is a sort of Europe first agenda, right? But in the context of the European Union, it's a very different meaning in terms of what Europe first means. It means for Europe first above national interests. The question is, with a lot of these issues that we have in Europe, are they willing to relinquish sovereignty on issues like, say, the Capital Markets Union, or say, having national champions, not at the national level, but at the European level? And that is where we go from the Draghi abstract to the Draghi reality. And that is where things get very difficult, particularly in a moment where you have the German government that has just collapsed. France is not as strong as it used to be. And I'll just end by saying, behind me here, you can see the sort of logo for the Hungarian presidency here is the Rubik's Cube. It is a sort of great Hungarian invention. It's got 26 individual cubes that come together to one big cube, the 27 member states of the EU. A very difficult challenge to solve, though, getting through anything through the EU. And that is the sort of challenge that is for Ursula von der Leyen to solve with this new commission, which we're hoping to get at the beginning of December.
It's fascinating, isn't it? Many permutations to get to the same ultimate outcome. Ollie, thank you very much indeed. Bloomberg's Ollie Crook joining us in Budapest. Let's carry on the conversation around what is happening in Germany. Can we call it a political crisis? Is it an end to a political crisis? Basically, Chancellor Scholz fires his finance minister. We now get calls for early elections. The timing around that election is fascinating. Merz, who is potentially the next German Chancellor, is saying that it needs to happen sooner rather than later. Germany's Bureau Chief Christoph Rauwald joining us now from Frankfurt. Let's talk a little bit about how long Scholz can hold on for. He seems to be trying to dictate a time frame which nobody else seems to be really interested in. He wants to push this election vote out further. Many want it certainly earlier. What are we thinking about in terms of how long the time frame is between now and this general election in Germany taking place?
Yeah, I think the pressure is clearly growing on Scholz, not just like from his political opponents. We had the opposition leader Friedrich Merz stepping up getting on stage earlier today in Berlin, basically reiterating his calls. But you also get pretty sort of distinct messages also from the corporate side. I mean, many German corporates are increasingly worried that the sort of standstill in Berlin, the difficulties to come to any sort of political decisions, push through much needed reforms economically, that this is really slowing down the modernization that the government under Olaf Scholz has really pledged to deliver, and so far has not really made any meaningful progress, at least.
Christoph, you mentioned those key economic reforms. Can you walk us through what those actually look like?
Well, there's this one sort of notorious issue in Germany that has been a concern for many companies, for many investors for many years, and that is the bloated bureaucracy, a lot of regulation, multiple routes for each and everything. And that is something that has really hampered economic growth, and that is something that the government has pledged to address. So far, the announcement was there, but in terms of practical actions and things that are really tangible, the progress has basically been very, very modest, to put it politely, really.
Yes, and represent, and perhaps indicative of the infighting we'd seen in that ruling coalition then, Christoph. So if we do manage to move forward, and the timescale's still hazy here, a big question is around debt levels in Germany. I mean, what kind of appetite do we have from who is likely to lead Germany next to actually tackle that, to actually change that and do anything about it? Because the market seems optimistic about some change there, and yet the political makeup of a likely German government from here might not lead us to believe that we get a change to the debt brake.
Yeah, I think the market reaction that you mentioned, that was definitely, I think, mainly a reaction to the sort of hope that this deadlock and this slow decision making in Berlin will finally come to an end under any new government, which ideally has a stronger mandate and a less complicated structure than the three-way ruling coalition under Chancellor Scholz. So that was something that that definitely sort of fueled some hope. We've seen the market going up yesterday quite a bit, today as well, basically across like several sectors that so far have been held back because there has been really this backlog of decision making in Berlin. When it comes to the debt levels and the net borrowing limit, which is baked into the German constitution, so it's not something that you sort of can change like overnight. It's the hurdles are really, really high to change or adjust that. But that is something that the new government will have to address as well, because the need for really like very significant investments in Germany is more than evident.
Just a final quick question, Christoph. What is the CDU's attitude to common debt? It's interesting, Draghi's in Budapest today talking to the European leaders. Germany has been in some ways the biggest bloc to using common debt more often in solving some of Europe's big problems right now. Draghi is a big proponent of this. Does Friedrich Merz have a more open thought on this rather than the kind of closed thought that the current coalition has? What do we know about his history around this subject?
He usually tends to be a bit more on the hawkish side. Having said that, Friedrich Merz has in the past also, I think, made it very clear that whatever like the financing methods are, the need for investments is really very much evident when it comes to like the crumbling German infrastructure, investments in future technologies, semiconductors, chips, etc. All these things need to be financed. There will probably be some flexibility on Friedrich Merz's side if he was to become like the new chancellor, but he's not somebody who would like go out and say like let's sort of issue lots of like new debt and raise the debt level in Germany, which would also be like a sort of risky play, given that the German economy has been stagnating effectively for two years now. So when the economy is stagnating and you just pile up lots of debt, that's a pretty difficult and risky combination as well.
Yeah. I maybe want to lean into the cyclicality of all of this. Christoph, thank you very much indeed. Christoph Rauwald, Bloomberg's Germany bureau chief, joining us out of Frankfurt. Quick look at what is happening with the Chinese currency right now. The NPC is over. The press conference is over. This has been the reaction over the last half hour or so. You have seen a tick higher in the US dollar, a fade for the Chinese currency. This is not substantial. This is maybe a signal that what the market was anticipating and what was actually being delivered is a little different, but I don't think there's a massive difference in terms of the gap that we are seeing here. Anyway, that's been the market reaction. But as I say, the NPC has now concluded. More ahead. This is Bloomberg.
Welcome back to the opening trade. 8:46 in London, 46 minutes into a European session that has weakened a little bit as we've been hearing what's been developing through this Chinese MPC press conference. That's the negativity on your screen. So not outsized, but there is a little bit of it. We have some disappointment around numbers in the luxury sector as well. That no doubt weighing on the French market. The CAC 40 under pressure. Now, Chinese stocks and the yuan declined after authorities announced a 6 trillion yuan program to refinance local government debt. The move lower, signalling investors weren't impressed with the latest attempt to support the economy. For more, let's speak to Rebecca Chung-Wilkins, Bloomberg's Asia government and politics reporter. Rebecca, well, that sets things up a little, doesn't it? Investors seem to be a little disappointed, but disappointed in what? Take us through some of the detail as to what we've heard today.
I mean, all in all, just to give you the headline, essentially what this is a 10 trillion yuan debt swap program. So 6 trillion of yuan, as you mentioned, that is going to come in the form of refinancing, swapping out hidden debt for local government bonds. And as part of that, they've actually raised the debt ceiling for local government. That's happened the first time since 2015 that they've done that mid-year. In addition to that 6 trillion yuan, we also have 4 trillion yuan of special local bonds that again will be used as part of this debt program. But what we didn't hear about is anything specific on property, anything specific on consumption or trying to boost domestic demand.
Rebecca, I'm having a little bit of deja vu when you look at this market reaction, because about a month ago we had a similar one from the NDRC, and I'm curious how much of that dynamic has actually changed. To your point, they're falling short on that key word, consumption.
I think that's the really big missing piece here. And by the way, there was never particularly a promise, but actually there just had been a lot of speculation and a lot of expectation. There had been some media reports, for example, that suggested that China was actually going to set aside a hefty chunk of change into buying unsold property, for example. Now, that hasn't transpired today. Perhaps you can kind of link that to some of the commodities declines that we've seen in markets too. And so, again, there was also this bet that if we saw a Trump victory, that Beijing would turn and sort of have its hand forced into trying to introduce more support, particularly focusing around restoring domestic consumption.
Is it just too early? Are they keeping their powder dry? Are they just waiting to see whether 60% tariffs just turn up? Is that the strategy here?
Yeah, I think that's absolutely key. I mean, there's no real win or no real positive in trying to front run what exactly it is that we see from Trump. And by the way, sort of, we may not necessarily see 60% of tariffs rolled out on day one. It's likely that's just a starting point for negotiations. JP Morgan sort of talks about Trump potentially introducing these tariffs in the forms of stages, a sort of escalate to de-escalate playbook is what they call it. And so you can also very much understand from Beijing's point of view, this desire to sort of sit on that dry powder, to be waiting and recalibrating their response once they actually know what the sort of process is going to really look like. This is not just a sort of immediate trigger-happy response, that they're trying to balance the next 4 years of what might be a sort of bruising, unpredictable period of time for them. So I don't know if it's hugely surprising that we didn't see a huge number coming out the gates here, given that we just haven't seen that coming from Beijing throughout this process, despite that stimulus blitz. However, the market has become exceedingly momentum-driven, and so that's why we see such reactivity here.
Chinese don't want to start the fight just yet. Rebecca Chung-Wilkins joining us, Bloomberg's Asia Government and Politics reporter, on what we've heard this morning. Let's kind of put that in the context of what we're getting out of the United States and digest a little bit maybe the Fed rate cut that we saw yesterday and that Powell press conference. Bloomberg's Valerie Teitel sitting around the table with us. The Chinese don't want to start the fight yet. Could you argue that Powell does? He's basically putting a ring fence around Barr and signalling that he shall not be touched. He's saying that the Fed's independence is not up for debate. Would he resign? No. Can Powell defend Barr? I think is a key question here, though. It's like ding-ding round one.
The thing about the vice chair is important, but I want to state that I think maybe this is being overhyped because we have Powell who is easing, right? He's in a trajectory to cut rates, which is normally what a president wants. So, you know, the likelihood of pressure on him increasing, I'm not so sure if we're going to see that in the latter half of the year.
Right, yeah. I mean, and this was certainly the highlight, wasn't it, coming out of the Fed, was all about this. No, it's not allowed under the law. They can't get rid of me. They can't get rid of Barr. Not his words, but paraphrasing. Taking us, and these thoughts are linked, just want to take us to the European leaders meeting that's taking place in Budapest today at that football stadium that we've seen Oliver Crook at. Mario Draghi is there, and he is speaking now, and we know that they had gathered trying to have a conversation about European competitiveness. Mario Draghi is setting that conversation in a Trump context and saying that the Trump presidency will greatly affect EU-US relations competitiveness, that his report on that, it's even more urgent now, is what he's saying. And so for Europe, so much hanging on what the Trump administration decides to do when it comes to tariffs. Back to the Fed very much waiting, watching, seeing what we get on tariffs from a Trump administration.
And look, I think there still is a big question out there. What is the likely response from the Federal Reserve if we do get tariffs, right? A lot of people have said that they're more going to drive inflation, but some argue, Anna, that the Fed will be more concerned about the downside hit to growth that tariffs would entail. Many pointing to this paper from the Fed out in 2018 that said just that. On a rise in tariffs, the impulse of inflation, the Fed should look through because the downside risk to growth was more meaningful. And if the Fed did hike in response to tariffs, a recession would ensue. That is what this paper showed. We also heard Waller comments a few months ago, who basically, when he was asked about tariffs, pointed to the same thing, that they're more worried about downside risks to growth rather than it boosting inflation in a meaningful way next year.
We talked a lot about central bank independence all week long, and certainly in the lead up to this election as well. Is that really at risk here, especially when we're talking about a dynamic where, as you rightly point out, there are papers, there's a historical precedent that suggests tariffs equal Fed cutting rates? Is that still relevant?
Look, I mean, the other argument I think we need to talk about is the response to the fiscal loosening of these implied, anticipated policies from the Fed. And do we see a Federal Reserve in December already upgrading their growth forecasts in anticipation? Now, the Fed Chair Powell told us yesterday that they don't want to speculate on policy. But let's look back to 2016. When Trump was elected, the Federal Reserve that December did upgrade their growth forecast on an anticipation of fiscal loosening. And that would imply we could maybe see a Fed on hold in December if they do with this new round of forecasts, if they upgrade growth, if they upgrade inflation, if they change their dot plot to reflect that there's less easing needed next year. We could possibly see that being translated as the Fed is on pause at the moment and they won't cut rates in December.
But the expectation is, therefore, that if the Fed is not cutting, what does that mean for everybody else? What does that mean in terms of the spreads across the Atlantic? What does that mean in terms of kind of what euro-dollar does? Is that the right way around of thinking at it?
I don't know. I would flip it around, and I would say that the world would be more positive about the upside risks to the U.S. economy. This economic growth engine coming out of the U.S., I'm less concerned about rates staying higher because this strong U.S. economy is going to
lift all boats.
Lift all boats, rather than the flip side of worrying about, rates are going to stay higher for longer. That's going to be a drag on economic growth.
I guess with the tariffs, that's where the tariffs get folded in and kind of how they could ultimately be applied. Well, thank you very much indeed. Busy week. Valerie Tettel, thank you very much indeed.
Should we mention some of these lines coming out of Mario Draghi at this event, at the European Leaders event, saying that the Trump election has deepened this sense of urgency, reiterating that line again. We have to negotiate with our US ally to protect EU producers, and to use your metaphor about boats, because we've had this conversation all week, to what extent does a strong US economy actually have a positive for Europe, even if tariffs don't? Maybe it depends how you position your boat. And that's what he's talking about here, about trying to make things better for European producers, even in a tariff environment.
Yeah, but also, how does Europe respond? Like,
with its own tariffs.
How does Europe aggressively respond to all of this? I think is going to be really interesting to watch. And Draghi seems up for the fight. That will be interesting to watch. Big plans for the weekend?
I'm watching Mario Draghi, obviously.
Watching Mario Draghi.
I think we have some things on the weekend agenda to mention, don't we? I think everybody needs a weekend.
I need a weekend. So tonight, lunch curry. We're going to watch New Zealand take on Ireland.
Excellent.
They beat us. It's very disappointing.
I needed some further explanation of the first item on here. It's a motorcycle exhibition. But then I found out it was in Milan, and I became more interested.
It should be like Bologna, maybe. If you think about kind of where Ducati is based, but that would be great. Lord Mayor's show, you going to
that? No, but I see the preparations outside the building, so it's good to know that's happening. So those things are all for your amusement over the weekend. A reminder, you can check out the Bloomberg New Weekend Edition as well. We bring you a collection of ideas, essays, reviews, interviews and stories that explore fascinating places where finance and culture meet. It's been a busy week. Have a good weekend. This is Bloomberg.